introduce our first speaker, Khatija Haque, who is the Chief Economist and Head of Research for Global Markets and Treasury for Emirates NBD. Khatija has more than 20 years' experience as an emerging markets economist spanning 3 continents before moving to Dubai in 2008. Khatija was Vice President at Deutsche Bank in London, covering several countries in Eastern Europe, the Middle East, and Africa. Khatija, how nice to see you physically on stage, and thank you for joining us today.
It's lovely to meet you. Thank you very much for inviting me. This is only the second in-person event I've done since 2019, so there is a little bit of stage fright. Please bear with me. I'm going to start my presentation with a global overview of where we are coming out of this pandemic, and then we're going to drill down a little bit into the region and where we see opportunities and where we see growth coming from over the next couple of years. So if we start with the global backdrop, I mean, this word stagflation is something we haven't really heard since the 1980s, but it seems to be more and more characterizing the situation that we're in. Global growth is slowing, and it has been slowing over the last few months, and that's really because of the spread of the Delta variant. Now, what's interesting is that if we look over here, you can very clearly see that countries that have had really high vaccination rates have been able to maintain very robust growth even as the Delta variant has spread, whereas countries, particularly in Southeast Asia, where the vaccination rates are much lower, we've seen a significant contraction in terms of their manufacturing output over the last couple of months, and obviously that then feeds into supply chain disruptions. This is the manufacturing sector for most of the world, and so that in turn is pushing up prices. So we've seen growth slowing. We've seen inflation rising quite sharply. What does that mean for policy going forward? So the Federal Reserve has pumped a tremendous amount of liquidity into the financial system since the pandemic started. You can see the chart at the top left, the size of the Fed's balance sheet has almost doubled. And that really is cash that's being made available to companies, to households, and to the financial system at large. There's very little way for the Federal Reserve to direct where that money goes. And that's the reason why I've called this slide Less Fed Money and More Biden Money, is because the global economy, and particularly the US economy, is in a much stronger place today than it was 18 months ago. It doesn't need that excess cash being injected every month into the financial system. We have seen a recovery in the job market in the US. We have seen a pickup in CPI on the back of strong domestic demand. So perhaps now the focus should shift to fiscal policy, which can then be better targeted to the sectors and the people that need it the most, rather than simply resulting in asset price inflation and financial market assets in particular. We haven't escaped the pandemic. We can see already in the US consumer sentiment at the weakest level that it's been since the peak of the pandemic last year. And that, again, is on the back of the Delta variant spreading. It's discouraging people from traveling. It's discouraging people from eating out. And that is now starting to have an impact on the services sector in the United States as well, although to a lesser extent than we've seen in Asia, again, because of that higher vaccination rate. So if we look at what we're expecting in terms of interest rates, obviously this is the big driver for investment globally. We do expect US rates to rise, but if you look at where we are still, we're sitting at around 1.4% roughly on the 10-year US bond yield. That's not at all where you would expect to see, or where we would have expected to see interest rates in a world where the US economy is growing at 6.5%, and headline inflation at least is around 5%. So this still reflects quite a lot of uncertainty and quite a lot of concern on the part of investors about how quickly the Fed will be able to normalize monetary policy, how sustainable this growth is going forward, and a tremendous amount of uncertainty about what the next couple of years might look like. If we look now at the GCC and how that has emerged from the pandemic, we can see as a starting point that the direct fiscal stimulus that was provided by governments in this region was far lower than what we were seeing in the biggest economies. And that's natural given the business model here, given the economic model here. This is largely a tax-free region. So it's very difficult for governments to give back fiscal stimulus when things are bad, when they're not actually collecting revenue when things are good. So the nature of the support in this region was quite different. It was largely focused on maintaining liquidity in the system so that banks could continue to function and provide support to their clients where they needed it. But because of that, we did see a significant contraction in the private sector last year. We saw job losses, we saw people leaving the region because they had lost their jobs, we saw salary cuts, and all of that has meant that the recovery has started from perhaps a lower base than we would have preferred to see. So where does that leave us now? Well, if we look broadly at the region, we can see that private sector activity is picking up. Businesses every month are reporting stronger activity growth, faster new order growth than they were the previous month. We're also starting to see some pickup in private sector employment across the region, which is very, very important. That is a big driver of consumption, and consumption was one of the hardest hit sectors of GDP last year. If we look at Saudi Arabia, for example, consumer spending in the first 7 months of 2021 was up by more than 10% on the previous year. And that's despite higher value-added taxes being imposed and despite additional taxation rates as well. So there is appetite in the region, there is pent-up demand as well, and we're hoping to see that pick up over the next quarter and into 2022 as well. Obviously, we have got significant budget deficits in the region. The priority for governments this year has been to narrow those deficits. So whatever recovery we've seen in the region has not been because of government spending. It's actually been driven by an external environment that's improving and a private sector that's feeling more comfortable with the situation and starting to boost activity. And I think this is something that is going to stay a big focus going forward. This region historically has always relied on government spending to drive growth. We think that model is going to change. It has to change in a world that's moving away from oil and gas for a region that largely is reliant on oil and gas production for its revenues. So where does that leave the UAE? We are expecting growth to accelerate in 2022. Some of that will come from greater oil production next year because OPEC overall has agreed to increase production through 2022. But we are also expecting the non-oil sectors to gain momentum. What we've seen in the UAE over the last decade has been a significant investment in physical infrastructure. It's the logistics, it's the ports, it's the airports, the tourism infrastructure, and of course, the preparations for Expo 2020 have underpinned that investment over the last decade, even through times where oil prices have fallen very sharply and a lot of other projects around the region were being scaled down. Dubai had to invest because they had an event that they were going to host and they needed to be ready for it. So arguably, a lot of the benefit of Expo 2020 has already been felt in this economy. Nevertheless, it is a great marketing tool for tourism going into the fourth quarter of this year. We are expecting a bump up in spending on the back of that event. The easing of travel restrictions over the last few weeks even. So when we look at the lifting of restrictions on Saudi travel to the UAE, the reopening of UAE borders for countries like India and other countries in Southeast Asia, these are big markets for tourism in Dubai, as you know. And so we are expecting that demand to come back. And hopefully the fourth quarter will be a very strong one for the sector. But going forward, the UAE's focus has clearly shifted. The infrastructure is already here. Arguably, there's a little bit too much of it at this point, but the demand will follow. So the focus now has shifted to the more value-added areas of growth for this economy. So what does that mean? That means investing in manufacturing, stuff that the UAE actually makes and then hopefully exports as well. It's looking at more technology and technological-driven growth. So that, of course, means hiring the right people and attracting the right skills. And in order to do that, we've seen a significant number of announcements on visa reform, which I think over the next couple of years we will start to see significant benefits from in terms of making the UAE a much more attractive destination for higher skilled talent that is then going to drive the value-added GDP in manufacturing and in technology, and of course in clean energy, which I think is going to get a much higher profile in terms of government investment and government policy-driven progress. So Saudi Arabia is still going to follow perhaps a slightly different model. There is still a huge amount of scope for physical infrastructure investment in Saudi Arabia. So when you look at what the Vision 2030 set out in terms of goals that the kingdom wants to reach, whether it's on healthcare, on education, on standards of living for Saudis, that requires a significant amount of investment in infrastructure, in real estate, and of course providing the services that the domestic population has perhaps usually gone overseas to get. So I saw a statistic the other day that said that something like 70% of Saudi spending on leisure is actually being outside of the kingdom. So this is the 30 million odd population which has basically been spending their money abroad, and that money will now be brought back into Saudi Arabia with the development of the leisure industry, with the development of the domestic tourism industry, and the delivery of infrastructure in those sectors. Of course, the big projects have been NEOM, the Red Sea Development Company. Those are going to be driving growth for the next 3, 4, 5, 6 years. The government has cut spending in the budget, but they have diverted a lot of the assets into the Public Investment Fund, which is Saudi Arabia's sovereign wealth fund. And the PIF is basically going to be the engine for public sector investment into those key sectors. And in addition to that, of course, the kingdom has become much more aggressive over the last year or two in terms of trying to attract foreign direct investment into Saudi Arabia as well, to supplement the money that's being put in through the Public Investment Fund and to drive growth in those key sectors going forward. So if we look in the GCC, I mean, this is really where most of the growth is going to come from probably over the next couple of years. And then lastly, I want to touch on Egypt. It is one of the countries that we cover at Emirates NBD. Emirates NBD has a bank in Egypt as well, so it's a big market for us as well. It was particularly hard hit on the tourism side last year. It is a significant employer for Egyptians, and it's also a significant source of foreign exchange revenue, and that basically fell away completely. But notwithstanding that impact on the domestic tourism industry, Egypt, in terms of its overall economic development, actually managed to post positive GDP growth last year. It's one of the few countries that went through the pandemic and actually had a positive GDP at the end of it. Turkey is the other one in our region that was in that position. A lot of that was driven by government spending and government investment, and we expect that to continue. And then, as with most other places, where government money goes, private money follows. And so we are expecting Egypt's economy to post a very solid growth rate over the next couple of years as well. We are seeing a return of visitors, most notably Russian visitors have returned to Egypt this year. That historically has been a big source market for them, so I think that is a very positive indicator, hopefully, of the direction in which Egyptian tourism will continue to move. I'm going to stop there. I don't think we are able to take questions now, but I will be outside over the course of the afternoon, so if you have any questions, please feel free to come up and say hello.
Khatija, thank you so much. Actually, I do have a question for you.
Okay.
I do have a question for you. So with this slowdown in the economy and with rising interest rates expected, how is that going to impact the stock market in your view?
I can't predict the stock market. I will say that it's had a tremendous run. interest rates are still very low. So even if we're looking at a 25 basis point or a 50 basis point increase in the Fed funds rate, that's only going to happen in 2023, most probably. It doesn't really significantly change the cost of funding for most of these companies. So I think as long as they continue to grow, and certainly the tech companies are posting very strong growth, I don't see that there's a reason for a significant correction in the stock market. Having said that, famous last words, so certainly don't take my word for it.
No, only because I want to report later on, like I did earlier with Roger Boodle, that, when you predict things, we can then,
yeah, that's what
follow
I'm
up
afraid
at a later stage. But you just mentioned on the tech sector then, do you think the tech sector is slightly divorced from the real economy now?
Well, it's where all the growth is, right? So, and this is one of the reasons why, people are always saying inflation is not transitory, that the Fed is wrong. But if you look over the last, 20, 30, 40 years, technology is deflationary. And given the changes and the growth in new technologies and innovation over the last year and a half, you could argue that as that becomes much more embedded in the real economy, the price of everything will continue to moderate. So overall, it's a good thing, obviously, for those companies that are creating the innovation and the new technology. But I think for everyone, ultimately will benefit from lower prices, more productivity, and all of these things are good for the stock market.
Excellent. Okay, Khatija, thank you so much. Please show your appreciation to Khatija Haque.